Good afternoon. My name is Stacy Borneman. Thank you for joining us today for the next in our expert webinar series on planning for the future, presented by Envisage. Envisage, what is it? Envisage is a long-term planning solution for older adults age 60 plus that helps you anticipate your future care needs and plan for them now. Envisage is brought to you by your leaders in aging services, Presbyterian Senior Care Network and Lutheran Senior Life. Envisage partners with experts like Bob Bruce to help older adults in planning for their future. Envisage is a long-term planning solution for adults age 60 plus that lets you anticipate your future care needs and plan for them now, as I mentioned earlier. But Envisage is far more than a financial plan. It's a plan that includes a focus on health and wellness, as well as care coordination, should you need it in the future. All of these things combined help us address the greatest concern that most older adults face: how to minimize the caregiver burden on your family and your friends. Did you know that 70% of people over 65 will need some type of long-term care? It's a large percentage. And additionally, 79% of future retirees indicate that they're most stressed about having to change how they had planned to spend their savings because of potential healthcare costs. So I ask you, do you have a plan in place for who will take care of you should an unexpected health event occur? And even if you are covered financially, do you have a plan in place for who will take care of you should an unexpected health event occur? If you envision a future of living independently in the home that you love without being a burden to those you love, your family and friends, Envisage might be right for you. Visit us at www.envisage.org or call us on the number on your screen. Today, I am very excited to bring to you our speaker, Bob Bruce. He is the founder and CEO of Integrity Wealth Consulting, and many of you may recognize him as a former TV journalist. Bob has been working as a financial planner for more than 20 years, and he's a recipient of the 5-Star Wealth Manager Award, an award that less than 7% of wealth managers in the state of Pennsylvania receive. Thank you, Bob, for joining us here today.
It's time for me to go, I guess. Good morning, everybody. It's great to be with you, and I want to thank the folks at Envisage for inviting me to share a little bit with you during these crazy, tumultuous times. Obviously, most of us on this webinar have been on this earth for more than a couple of years. We've seen a lot in our lifetime, but right now we see stuff that may confuse us, may put a lot of fear into us, and may cause us to commit really egregious errors when it comes to our financial planning. So I thought I'd break it down and make it pretty simple for you, because it is really simple. Despite the complications that we're facing now in the markets in general, in life, the uncertainty of a presidential election, you have to kind of separate yourself a little bit from that and look at 5 important things to do right now. And really, number 1 is pretty simple. And most people will say, well, Bob, come on, I've got to do something. No, absolutely, overwhelmingly, normally, the best thing to do when you're in the midst of a huge market correction, huge social change. I mean, let me just mention the year 1968. Most of you lived through 1968 as I did, and things are pretty crazy then. The best thing probably to do is not do anything. If you have a good financial plan, that plan should have been constructed to know that there will be storms ahead. It should also have been constructed with a good emergency fund. It also should have had some of your assets not in the stock market, so that you can go through this storm, which, by the way, is kind of like a really bad hurricane, but it's not going to last forever. And that's why many people, probably the most common question I'm asked today is, why is the market doing as well as it is, considering everything that's going on? Because the big money, the institutional money, the guys that do this for a living, look at it as a hurricane. This is bad. It's causing a lot of problems, but they're looking down the road. They're saying, is this going to last forever? No, it's not going to last forever. I guarantee you that. We've seen 9/11, and I mean, I could mention 100 different things to you. I always tell to my clients, if you give me all the years in the past, pick what year you want. 55, 72, 85. I could probably give you 100 reasons why you should never invest in the stock market. But this country does go forward, and it will continue to go forward. But it's natural in these days and times, as we go to the second thing to remember. First, don't do anything. Second, you don't react to the market, you adjust. More often than not, when people are feeling afraid of the market, with number two, don't react, adjust. When they're afraid of the market, they have a tendency, and our brains are wired this way from the time we were cave people, is that if there's danger, we either want to fight or we want to flee. Well, it's almost impossible to fight the market. So what's the number one reaction most people make, and it's always a bad one, is they flee. They lock in losses. Let me tell you how bad a mistake people have made. When we hit 18.5 on the Dow and people sold out over the next 2 days, that was back up to 25.5 in the space of about 5 days. Now, most people and clients told me, my gut feeling, the market doesn't react on gut feelings. Emotion does play into the markets, but your gut feeling with your financial plan, you can't really let that take hold of you. You've got to go back to the plan. You've got to go back to how you feel about risk. You know, how do I feel about the risk I'm taking? Maybe you were taking too much risk, and this is a great time to adjust that financial plan so that as we go forward, and there'll be more big disruptions in the market. It is going to happen. It's just the way the world works. You have to be able to adjust, but don't react. Don't flee, because in that case, you're going to do a lot of trouble, a lot of damage to your portfolio. The other thing I always tell my clients is that, I'm sure all of you out there have heard, as we move to number three, diversification. And diversification is important, but it has to be diversification with a purpose. There has to be, a lot of people, when they talk to financial advisors and people within my business, and remember, I come out of another business, so I'm kind of a different kind of financial guy. Well, diversification, that's stocks and bonds. No, it goes way beyond that, way beyond that. It's cash, it's stocks and bonds. It's really taking, as according to research at the Wharton School of Business, you have to immunize some of your wealth from the markets, because the markets, the stress that you experience, especially later in life. If I have a 70-year-old, a 65-year-old, or an 80-year-old, my mom's 92 years old. She has 60% of her assets in the stock market. People go, oh my God, that's crazy. No, it's not crazy, because she would have run out of money 15 years ago if she had done that. But we also have some of her assets immunized to the market. We've used very, very low cost, and I'm going to mention what is supposedly a bad word, but it's not. There are a lot of bad annuities out there, but there are new annuity products that are based on indexes that are away from the market, that protect your downside and are very cheap and inexpensive. Most annuities are outrageously expensive. The newer annuities give you the opportunity to take 10 to 15 to 20% max. You never put into annuities and lock that money up, but that protects that money. That protects your income. And what we like to do is say we immunize a portion of your portfolio, combine that with Social Security, so we have a certain amount of money that we know is not going to go up and down with the market. And even within stocks and bonds, you have to diversify in that instance. Where how much? The number one thing I see with older clients, and I'm older, I'm 67, with older clients, is that they'll say, well, I want to put all my money in bonds because they're safe. Bonds are not safe. I don't know where that ever came about. Maybe back in the early 80s, bonds would just clip a coupon and you're fine. But now, remember, with bonds that are supposedly safe, people are buying into bonds now at a very high price. That drives the interest lower. You make less and less money. When stocks take off again, then all of a sudden people are going to jump out of bonds. Your interest rate is going to go up, but then the price you paid for that bond is going to go down. So it's inversely related. So you have to be very careful about what diversification you're doing between stocks and bonds, annuities, cash, and always have a good solid emergency fund so you can outlast the dips in the market, so you won't be forced to sell to finance your life. Here's another one that just, if there's anything besides redoing kitchens, it's probably the most popular topic in my office. I want to redo the kitchen. If there's anything else, it'd probably be number two is people come in, clients, and they compare their financial plan to their friends. well, my friend's making this much money and my friend's doing this, and my friend's doing that. You have no idea what that friend is about, how they feel about risk, what assets they have. I mean, I would run as far away as possible if someone tells you, well, I do this. Everybody is a unique individual, and every single person that we work with at Integrity Wealth Consulting is absolutely a unique individual. There's no cookie cutter, there's no nothing, because everybody feels different about risk. In fact, if you put a married couple in the room, I guarantee you, I don't think I've ever talked to a married couple where they both felt the same about risk. One of them, and it's not like, well, the female's always more conservative or the male's always more aggressive. That's not true. I've seen it both ways. Doesn't matter, where the wife maybe is more aggressive, but the husband is more conservative. So that's when you've got to really get together, and you've got to compare that, and you've got to come up with a consensus to where everybody has a tendency, when they put their plans together, we have a tendency as humans to think that everything is going to go 1, 2, 3, 4, 5, and everything's going to go according to plan. That never happens. Never happens. It'll go 1, 3, 4, 5, 7, 9. And so you have to adjust along the way within your financial plan, and you can't be listening to what other people are doing because they have a different life. I mean, I ask you this one question. Ask yourself, is there anyone else in the world that's exactly like you and has the same likes and dislikes and the same needs? No. So you need to find a way to get a unique plan, and you have to have a plan. Some people say, well, I can do it myself. You know, I don't need a financial advisor. And I know I have a conflict of interest because I am a financial advisor, but I also wasn't a financial advisor for 36 years when I was in broadcast journalism. So I've seen both sides. People think, well, I can do it myself. I can buy mutual funds. I can buy indexes. I can buy. It is a recipe for disaster. Stocks are traded in milliseconds. I mean, the way the market moves today and the speed at which it moves. In the old days, if you had a correction of 500 points, that might take 2-3 weeks to happen. You can have a correction of 500 points in an hour, the way the market moves now. So it's very, very difficult, and you have to take that into account when you're trying to put together a financial plan. And I will tell you this, you work with the right financial advisor, that person cutting expenses and taxes will save you way more money than you ever pay him. Now, when it comes to a financial advisor, the question I get asked all the time is, how do I find one? What should I look for? Because it's a marriage. You know, the clients that we have in our practice, I've had clients that I've worked with for 22, 23 years. They'll be with us for the next 20 years. Long after I'm gone, my son Scott will be handling their accounts. So we're really a continuum intergenerational firm. So you want to look for somebody that has not just a guy like me. I'm 67. I'm going to work till I can't work. But in a lot of instances, people will get a guy, a financial advisor, who's 60, 65 years old. All of a sudden he retires, and now you got to start from scratch. So you want to look for a firm and ask that person, do you have a succession plan? Do you have someone that will take over this so we don't start from scratch? Now, when you look at the education of a financial advisor, you want to look for a certified financial planner. That is what my son is, or a certified investment management analyst, for a couple of reasons. Number one, you know that they've gone through rigorous testing to get that certification. You know that they have to do multiple 40 hours a year I do just for that one certification. I'm also an accredited investment fiduciary. I go through a lot of continuing education. So you know they're current. You know they know the current laws, the current taxes. That's what they have to do. And more importantly, both organizations have separate code of ethics, way beyond what the government requires, way beyond the fiduciary laws. They have a very strict code of ethics that we have to follow in order to keep our certification. So let's go through that quickly again before we talk about doing some questions. Number one, are you a fiduciary? Number two, how do you get paid? And number three, what's your educational level? And then once you get all that, and also number four, I've kind of come up with more as I talk. Number four, do you have a succession plan? If I come to work with you, Bob, and you get hit by a car tomorrow, am I going to have to go out and do this whole process again and look for somebody else and try to get comfortable with them and redo my whole portfolio? I also will give one other tip. When you're looking at your current situation and your financial plan and the guy you're working with, you want to make sure you have a good, solid financial plan. and you want to make sure you're updating that on a regular basis. Because in my opinion, and the way we've always operated, we have the client here, we put together their financial plan, we find out about their goals and risk, and then, only then do we look at investments. Investments truly are, and a lot of financial guys would scream when I say this, they're the easiest part of the whole process. The hard process for us is really learning who you are, and your financial advisor should know who you are, your hopes and dreams, your risk, your goals. You know, they need to do that. They need to figure that out first. They need to put together a plan to know how much emergency fund you need, how much you need for other things, and then they look at investments. And you know, your financial plan is never complete. It's like a jigsaw puzzle on the ocean. It's floating and it's all together, but all of a sudden here comes a wave, somebody gets sick, somebody needs money, a child has a problem, whatever. All of a sudden now, pieces of that puzzle are floating on the open ocean. So you've got to get together with your financial advisor and figure out, how do we put our puzzle back together again to make it work? Right now, people should be looking at their financial puzzle and their financial plan and saying, are we where we need to be? Do we need to adjust? Not react. You want to adjust. And I think we have just a review of the 5 things that, you know, probably right now the best thing to do is nothing until you really sit down and you analyze where you are and where you want to be. Don't react, adjust. If there's one thing I've told our clients a million times, and I guess because I was in the stressful business of news and I covered 9/11, the Oklahoma City bombing, I don't react to things emotionally. I look at the facts and I adjust to what is happening. Because if you react emotionally, 9 times out of 10, you're going to make a mistake. And I've seen guys that have been in this business for 35 years absolutely panic, absolutely throw everything in cash, absolutely make the wrong. It just doesn't work. Don't react, adjust. Also diversify and immunize some of your investment portfolio and make sure you have a good emergency fund. Don't compare your plan to your friends. That is always a recipe for disaster. And work with a financial advisor. And I will say, after going through all this, we're here talking about Envisage. If there's one Achilles heel that almost every American has in this country today, and that's a lack of long-term care. They have not, in their financial plan, provided for long-term care. As a fiduciary, if I don't mention to a client and go through with them why long-term care is necessary, the cost that they're going to incur, even without long-term care, the average couple retiring at 65, living to approximately 90, and that's what the insurance companies are saying now. They're going to spend a couple is going to spend 200 to 250,000 on out-of-pocket medical expenses. That's not even talking about long-term care. So you can see that anybody who sits down and does a financial plan and doesn't really look hard at healthcare cost in retirement and long-term care are missing one of the biggest weak points of almost everybody I talk to. So that's very, very critical. So always stay in there. Don't panic. You know, I know it's really hard right now, and I know when you watch the news, I went from where there were 2 newscasts a night to now it's 24/7. You're bombarded constantly. You would have a big story back in the 80s or whatever, you'd hear about on the 5 or 10 o'clock news, and then you wouldn't hear about it again for a couple of days. Now it's nonstop, nonstop, nonstop. They are force feeding a fire hose at you of information and a lot of conflicting information. So you need a guy, you need a coach. And a good financial advisor is also a good coach to help you assimilate the information and say, okay, what does this mean for me and my plan? So, I mean, I can go on and on and on, but I want to get to some of your questions because that's the most fun for me, and see if we can answer some of the things that are on your mind right now. But if nothing else, please don't panic. Don't sell things out. Don't make that critical mistake where you'll never be able to recover those funds because you don't have the years left to do it. Stacy, are you there?
I am. Thanks, Bob, very much. Hoping everyone can hear me. Sorry for the audio issue we had for a little bit of time there. If you have any questions, as I mentioned earlier, please feel free. If you have a question you'd like Bob address, click the chat click the chat drop down in your webinar dialog box and just type the question. We have had a couple questions come through, so as those of you are thinking about questions you may have, please continue to type those. And the one that came through, Bob, is what typically happens to the market during an election year, which we know we're in?
Well, before I answer that, I want to say there's no such thing as a bad question. 36 years in television, believe me, I asked a lot of bad questions. You got to ask questions because you don't know if it's good or bad or whatever. So you're in a safe environment here. You can ask anything. You know, it's funny when you look at the presidential election, and I have very conservative clients and I have very liberal clients. So I'm like Switzerland in the middle. I like to look at facts. I'm just a news guy. I look at history. I look at facts. And you would think, you know, you kind of have more of a pro-government candidate this year, and you got to have, you know, a more pro-economy guy. But in reality, if you look at the actual facts, it doesn't make a lot of difference to the market who wins. Now, this last case was kind of an outlier because the market went up a lot because President Trump started taking off regulations. So that was an outlier. But if you look at, you know, look it up online if you want, if you look at what the market did in the year after the election, Democrats did a little bit better than Republicans, not by much, but that usually evens out during whoever happens to be president. I've always said that presidents get far too much credit and far too much blame for the economy. A lot of what makes our economy work are the men and women who work in the companies, who create things, who invent things. That's why we have the strongest economy on earth. And that's why before we went into this, I'll never forget the meeting I was in with a bunch of managers in March. We were in the strongest economy in the history of mankind. There was not one bad number anywhere. Everybody was making more money. Everybody, the boats were all going up, and then everything happened. If this would have happened in 2008, we'd have been in deep trouble, but it's not 2008, and we were very, very strong. And the word I hate to hear people say is depression, because this has nothing to do with the original depression. The depression was caused by a stock market that was very underregulated, fell apart, and we had one industry at that time in this country, and that was agriculture. And the Dust Bowl days, you know, destroyed agriculture. So that's why it took, and there were some missteps with government. That's why it took forever to recover from that. That's not true now. There are a lot of companies, despite all the craziness going on, that are doing fantastic. I'll give you an example. I actually talked to one of my friends who is in the soft drink business. Their business is booming. People are buying all kinds of soft drinks to drink at home. They're staying at home. They're buying food. They're buying, you know, so there are some industries like hospitality. Where I'm sitting right now, I happen to be in New Mexico. This hotel now, she told me, well, we reached our 50% capacity. We can't bring anybody else in. So it's going to take time for that industry to come back. So I don't think it's going to make a ton of difference. I could have debates and arguments about that all day long. I think the key is look at business, unless there are seismic changes in regulations and government regulations on businesses, I think we're going to be fine.
Thank you. Thank you, Bob. Another question we have, it says, what happens if we have a second shutdown due to COVID-19? Are you still advocating that we stay the course? I'm 70 now. I recognize that I'm not 30, 40 years old anymore. How do I make up for the downturn?
Well, you're 3 years older than me, so I mean, we're kind of in the same group. I certainly wouldn't get out of the market. I think it would be almost impossible for them to do a total shutdown of the country again. I don't think the majority of people would put up with it. I don't think that would work. I think they see that they have to open the economy because it's almost a double-edged sword. You want to save lives from COVID, but you don't want to destroy and kill people by killing their businesses and sending them into poverty. Poverty kills. Poverty absolutely kills. So this is a perilous time where politicians and people have to balance those two things. I would, if you're worried and you're 70, I would go down and sit with my plan and say, how much do I have in emergency cash? This will pass. Even if there's a second shutdown, it will pass. The market will come back. We will continue to build businesses and sell computers or whatever. But you want to make sure you can last through those lean times and you have enough income. Now, one thing my son always says this, Scott always says, we can't control the markets. We can control our expenses. And that's one way where right now you might look and say, you know what? I'm going to live a little closer to the vest right now because we could see another shutdown. I'm not going to spend quite as much money. I'm not going to take that vacation. I'm going to wait till things cool down a little bit, and then I'll go back to that. But let's kind of play it close. Let's kind of, you know, close the shutters a little bit for the storm to kind of keep it at bay for a while. But I would not go in and just say, well, I'm going to put in the cash, because you put in the cash, you're not going to make any interest. You're not going to make any money, and you're going to lose to inflation, and you'll slowly run out of money. So it's that important mixture. There's a very important study that I'll do real quickly. 100 pension funds studied where they got their returns in their investments. And it was shocking. And Benson Biebauer is the study. Mr. Biebauer worked for a company in Philadelphia, SEI, and they found that out of those 100 pension funds over 10 years, 1% of the returns had to do with market timing. What does everybody try to do? Time the market. You can't do it. It's ridiculous. Every time I hear somebody saying that, I'm going, oh, I'm going to get out here, I'm going to get back in. You got to be right twice, when to get out and when to get back in. Nobody's that smart. Number two, the actual stock or bond you buy accounts for 4%. 4% of your returns, whether it's this stock or that bond or this index fund or whatever. 94 to 95% of your returns comes from your asset allocation and how it's combined with your financial plan. That's how important that is. So people need to forget about timing the market, forget about, well, if there's another shutdown, should I get out now? When do I get back in? I saw people that got out in 2008 and the market started going up. Well, do I get back in? No, I'm not. I'm still afraid. Do I get back in? Well, by the time it got to that higher level, all that money, that space in the middle, all this was gone and they would never get it back. So that's why I say you have to adjust, not react. So if you're 70, I can tell you right now at 67, I have substantial investments in the stock market and bonds. I have a fixed annuity, an indexed annuity, you know, and I combine all that together and I feel pretty comfortable with emergency funds and everything else that we'll be fine and that this storm will pass.
Thank you, Bob. We do have a couple more questions, and we have a participant that's asking or commenting, aren't annuities taxed at ordinary income rates versus capital gains tax?
They are. They absolutely are. So that's, once again, why you would never put all of your money into one of those. But you want to do about 10 to 15%, 20%. And it is going to be taxed, but you're not going to be taxed on it till you pull the money out. So you're getting compounded interest there, which is very, very powerful. So you want to look at, you kind of balance it. Yeah, it's taxed a little bit more than long-term capital gains. Well, that's why we're not going to put all our money into it, which I have seen. Believe me, the abuses of annuities are just astounding to me. I could do a documentary just on that. You want to take a small portion and say, okay, we're going to use this. Maybe we don't use it for income now. Maybe we'll use it 2 years down the road. But we know that there's a floor, there's a protection to this money, because the right type of annuities are not even invested in the market. That money's taken and invested by the insurance companies. And you say, well, the insurance company could go broke. Well, yeah, but not the ones that have been in business for 130 years and have gone through the Depression, 2008 or whatever. I mean, they know how to make money. The key is to not get any kind of annuity that's expensive. It has to be down around 1.25 or lower. Otherwise, they start adding on all these expenses, and suddenly you're paying 3.5%, 4% for an annuity. Maybe you're making 5%. Well, that doesn't make sense.
Bob, I heard you say—
I hope that answered your question.
I heard you say a lot earlier about diversification. And so there is a question out there that says, what are 5 types of investments that you have used to diversify beyond stocks and cash?
Well, you're pretty fortunate now because the laws have changed dramatically since 2008. In the old days, to use an alternative, when I say alternative, it could be real estate, it could be loans, it could be credit, it could be senior secured debt. In the old days, to be extremely wealthy to be able to do those kind of investments. Or if you did those investments as recently as 5 years ago, you would be locked in. You couldn't sell your investment if something went wrong or whatever. They have a new thing called interval funds. And interval funds basically give you access to alternatives such as credit or real estate. And they give you that access, yet you can sell it on a daily basis. You can get out whenever you want. And a lot of those interval funds throw off 5.5 to 6% a year in distributions. That's very, very powerful, especially if you're on fixed income. So you can look at those and you have access to them now where you never had access before. And how important are alternatives? Well, I heard this story, and I don't know if it's totally true, but Warren Buffett supposedly was on the board of Peru State University. That's in Nebraska. I worked in Omaha, Nebraska. How I didn't meet him, I could be a millionaire now. I never met Warren. But Peru State University said, you've got to diversify. We can't have just stocks and bonds. So he bought the local radio station. Different stream, doesn't react the same as the stock market. If you look at the University of Pittsburgh, they probably have 40 to 50% of their investment, their endowment in alternatives, not stocks and bonds. You look at Harvard, same thing. Look at the Pennsylvania State Teachers Association. Last time I looked, they're about 20% alternatives. So it's not, do I need alternatives? You have to have alternatives. And once again, I go back to the science. This has been researched again and again and again. And at Wharton, we've looked at it many times. If you add alternatives, you lower risk and increase return. I'll say that again. You lower risk and increase return. And now is probably the greatest time ever for the average investor to be able to have access to these types of products that would have been prohibitive in the past. So that's another thing that you need to ask questions about. See, a senior secured loan is basically like a mortgage. I give a loan to a business and they put up their buildings and everything up as collateral. So if they default, I get all their stuff and I can sell it and I can get my money back. So there's a lot of security behind that. Senior secured bonds, that's something you should always keep in your mind and look for something like that. But you can very easily purchase these interval funds, and a good financial advisor will do it on a fee basis, no upfront charges, none of that stuff. And literally there's one particular real estate, I won't mention the name because we're not doing a commercial here, but there's one real estate company that has had an appreciation of about 5% a year. In addition to that, has thrown off about 5.5% distribution rate. That to me is a win-win.
Thank you. Thank you. Just a few more. Bob, what is your opinion of long-term health insurance? Our annual fee is going up. We're paying a higher rate, takes less in payout, or do we take a less in a payout or take the money we have and put it in for 20 years?
Well, you need to absolutely don't get rid of that policy. If you have somebody analyze it, we've had this problem, Stacey, as you will know the problem because we've looked at this, is that when they came up with long-term care plans, they didn't index it for inflation, they didn't raise the fees along the way, and then all of a sudden they said, oh my God, we're in financial trouble, we got to do something, and now you have 50% increases. It's crazy. I've had some clients that have had if you got them way back, like my mother-in-law, who unfortunately passed this year at 94, she bought hers way back in the early 80s. That thing was worth its weight in gold. It had unlimited stuff. I mean, it was great. But then they started coming out with these dicier ones. And what we've done is if someone has one of those policies, we analyze it, first of all, to see if you can afford it. Second of all, the next thing you would do is say, I'm going to call that company, see if I can decrease my benefits. I wouldn't just part and parcel throw it out. You need to have somebody, good financial guy, analyze it, look at it and say, you know what? We just did this with a client. He said, well, we're going to take less payout, but we're going to keep some coverage because some coverage is better than no coverage, and no coverage it can be devastating to you financially, depending on your assets. If you got $20 million, it's not a big deal. But if you're sitting on 600,000 or $1 million or 300,000, and all of a sudden you start incurring long-term care costs, it can blow through that money pretty fast.
Okay, thank you. Thank you. So we signed up for a reverse mortgage. What do you think about them? We do not have any children or family.
Well, the reverse mortgage, they're bad companies and good companies, and it may be right for you. There are some people where the majority of their wealth is tied up in their home and the home's paid for. It's just a different way of paying back that loan. Tom Selleck does do a good commercial on it. I would never recommend it. I would do it as a last choice, as a last resort is the only time that I would do a reverse mortgage. I would look at everything else and see if there's any way we can right the ship without having doing that. I don't think if you're sitting in a home now and you own it, you say, hey, it's a great way for me to get extra money. Because if you read how it's paid off in the end, they're going to get their money one way or the other. And you got to be very, 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 very careful. I've never done any reverse mortgages for my clients. I've had many of them ask about them. Usually we've been able to work a different scenario and a different strategy. It's something to be careful, but it can be, there really are no bad products. It depends on if the tool is right for that individual. And that's the key. You got to have somebody who's smart enough to go, that's not for you. That is just not for you. You may think it's for you, but that could blow up and that could drive you crazy. Don't do that. So that's kind of where we stand on that.
I appreciate you saying that. I think that goes back to finding the right fit in a financial advisor for you that gets to know you and you feel comfortable with. It's
absolutely critical. Yeah, absolutely critical. It's, once again, I always go back to this, having I literally am a unique person in one aspect, is that over 36 years in television, I literally talk to every kind of human being you can think of. I mean, good and bad. And it really gave me a broad breadth of people and how they think and emotionally and everything else. And I just know that to go it alone is extremely tough in today's complicated, fast-paced markets. You got to find somebody you can trust. That's number one. And number two, you got to find somebody that's going to communicate with you and work with you on a regular basis and be there, and quite frankly, be a bloodhound and kind of sniff you out no matter where you're hiding and get you to do things. Because a lot of times, quite frankly, my clients know it's the best thing they should do, but then they, well, I got this going on. I'll get to that paperwork. You got to have somebody that stays on top of it.
Life can get in the way. I got one more question for you, Bob, and I appreciate the time you've taken to answer everybody's questions. Oil stocks, they're tanking now. Mm-hmm. What do you recommend?
I wouldn't recommend getting into oil stocks, because I think that entire industry is not the industry that those of you that are my age have known our whole lives. I have several guys in the oil industry. I go to Houston quite regularly. I talk to them, and there's a seismic shift in oil companies and in fracking companies. And Chesapeake Energy, one of the first frackers, just filed for bankruptcy. So you don't want, there's an old saying in Wall Street, you don't want to catch a falling knife. You got to be careful. You grab a falling knife, you can get cut really bad. I would steer clear of that. There are other places to go at the moment. There are ways you can play it where I guarantee you in your mutual funds and others that you do have those oil stocks. But if you look at Exxon, it's a totally different company than it was even 6 years ago. I'll give you, they're going through an upheaval like GE did. If ever there was a stock that anybody could depend on, it was GE. GE is totally fallen apart. It's not even remotely the same business, yet there's still people that want to buy GE because they think of the GE of 10, 15 years ago. So we've got to let the oil industry settle out to figure out, you know, what's going to happen. There's a glut of oil, the demand for oil. You know, we found when they learned how to frack for oil and for natural gas, that was a game changer. I remember years ago, the guys at work were telling me it's going to be the biggest geopolitical game changer in history, fracking. And it has made gas available to people that they never thought would be possible. It's made oil deposits that, you know, and we have so much oil in this country, we haven't even tapped. So unless demand comes back significantly, it's going to be based on supply and demand. And I would be very, very careful about jumping into oil stocks. There are other industries that you might see are beaten down now. In the hospitality industry, do I think that Marriott's going to go broke? No, I think they'll come back. So those are places where, you know, the airlines, I don't think, you know, maybe we might lose one airline, might go broke, but you know, it's risky. So if you're in a position where you can't take that risk, for heaven's sakes, don't take the risk. It's better to make 4% and make sure you make 4% than to try to make 10% and wind up losing 20.
Absolutely. Thank
These
you.
are excellent questions. This is to me so much fun. I just enjoy talking about. I could talk about this for 40 hours. But if I have one final thing to say is that, you remember the old Moby Dick movie? There are probably a lot of you out there that remember the original Moby Dick movie, and the really tough guy that they did an operation on his brain. And he had his hands, and he had tattooed on his hands, "Hold fast." Sometimes it's good to hold fast and have faith in your plan and faith in yourself. And may I say, faith in our country, which is the greatest nation on earth. Lord, we've had problems. We've got problems now, but we've always solved them. And we have the most unique economic system ever invented by man. Nothing even comes close. You have to have faith in that, which I do, or I wouldn't be doing what I'm doing. So I think there are good people out there. I think you really need to look at it. If you don't have long-term care now, you need to investigate it. You need to look at it hard, because any good financial planner will tell you that is an Achilles heel. No matter how much money you have, it's an Achilles heel. Either it can bankrupt you, or it could steal a lot of money that would be going to your heirs, to your children. So you have to make a decision, you know, do I protect myself? So once again, thanks to everybody in Envisage. Stacy, thanks for putting this together. I think there couldn't have been a more important time to discuss some of these things than right now.
Thank you, Bob. Thank you so much for your time. And as I mentioned earlier, and on the screen, you can see if you'd like to download a copy of today's presentation, click the handout drop down in the webinar dialog box, and that'll be available for you. And if you're interested in learning more about Envisage, we've talked a little bit about that at the beginning of the webinar today. Please visit us at www.envisage.org or the number there on your screen. And if you'd like to continue the conversation about this or any other things about how Envisage can help you prepare for your future healthcare needs and protect them now, please feel free to reach out to us. Bob, I can't thank you enough. And to all the people behind the scene that help us put this webinar on today, we appreciate you as well. Thank you. Take care.
Hold fast. Things are going to be okay.